America's housing foundation is starting to fracture. Prices that once climbed without limits are now colliding with a brutal reality. Mortgage payments have doubled, insurance premiums have jumped by 40 to 80%, and more than half of U.S. households can no longer afford a median-priced home. In multiple cities, inventory has exploded by 30 to 70%. Buyers have vanished, and homes are sitting untouched for months. The pressure isn't easing, it's accelerating. What follows is a look into the markets showing the sharpest signs of strain, where affordability has evaporated, demand has collapsed, and the first real cracks in the national housing framework are beginning to appear. Number 10. Seattle, Washington. Seattle is no longer the tech-fueled powerhouse that pushed home prices into the stratosphere. It is now a city sitting on a housing powder keg, one spark away from a full-scale collapse. For the first time in over a decade, Seattle's housing market is showing signs not of cooling, but structural failure, the kind that does not correct quietly. It unravels violently. The numbers tell the story nobody in Washington wants to admit. Housing inventory has surged by 35%, a massive red flag for any market, but in Seattle, where homes used to sell in 24 hours with 12 offers, this is a screaming alarm. Listings are sitting untouched for 70 to 100 days, and the bidding wars that once made national headlines have evaporated into silence. Seattle's market didn't slow down, it hit a wall. The tech sector, the bloodstream of Seattle's economy, is bleeding jobs. Amazon's layoffs crossed 27,000 employees, Microsoft cut 10,000 plus, and dozens of startups vaporized overnight. These are not low-income positions. These are six-figure salaries disappearing, precisely the group that was buying $900,000 homes like they were groceries. Remove that layer, and Seattle's price structure becomes mathematically unsustainable. Affordability has collapsed into absurdity. The median home price hovers around $760,000, yet the average monthly mortgage payment on that property now exceeds $4,800, a level even households earning $180,000 can't comfortably handle. When middle-upper income professionals can't afford the middle of the market, it's not a warning sign, it's a countdown. And the exodus is real. More than 30,000 residents fled Seattle in just 3 years. They're running toward places where a home doesn't require sacrificing half their income. Every resident lost is another unit of demand erased. Every employer downsizing is another nail in the housing market's support beam. Every stalled listing is another sign the floor is cracking. Meanwhile, an avalanche of new apartments, over 7,500 in a single year, with thousands more coming, has flooded the rental market. When rents weaken, home prices follow. It's a lockstep decline Seattle cannot escape. Seattle isn't cooling, it is depressurizing, like a market that has been inflated past its physical limits. And when a market that's dependent on tech wealth, cheap money, and relentless demand starts losing all three at the same time, it doesn't correct, it drops. Number 9. San Antonio, Texas. San Antonio was supposed to be the affordable alternative in Texas until the truth came out. Today, it's one of the most dangerously oversupplied, overextended, and structurally weak housing markets in the entire United States. What's happening in San Antonio isn't a cooling, it's a slow-motion implosion disguised by optimistic headlines and wishful thinking. Start with the demand collapse. According to recent regional housing data, San Antonio has reached a shocking imbalance: 117% more sellers than buyers. That is not a normal buyer's market. That is a market where owners are begging buyers to take homes off their hands. When supply doubles demand, prices don't dip, they break. Inventory has exploded more than 40%, pushing months of supply to levels San Antonio hasn't seen since the housing crash era. Listings that once sold in 10 days now sit untouched for 60 to 120 days, and price cuts have become the rule, not the exception. Entire new subdivisions, built for a wave of buyers that never showed up, are stuck with rows of unsold homes, forcing builders into aggressive discounting just to survive. Affordability has collapsed as well. Median prices pushing into the $310,000 to $330,000 range may sound low for Texas, but local incomes don't match. More than 45% of households are priced out of the median home, and mortgage payments have soared above $2,300 per month for typical buyers. In a city where the median household income is barely above $58,000, that's financial suicide. But the deadliest pressure comes from construction. San Antonio massively overbuilt during the boom. Thousands of new homes hit the market exactly when mortgage rates spiked and buyers disappeared. Builders are sitting on millions in inventory, and they only have one way out: slash prices. Once builders start cutting, resale values fall with them, and every homeowner becomes collateral damage. Population growth is slowing too. For years, San Antonio grew because it was cheap. Now it's no longer cheap, and residents are moving towards suburbs and smaller Texas towns where they can breathe. That leaves the core market exposed, empty, and vulnerable. San Antonio isn't heading toward a correction. It is entering a housing environment where oversupply, weak incomes, bloated construction, and vanishing demand collide. That combination never ends with stability. It ends with a drop that shocks the entire region. Number 8. Las Vegas, Nevada. Las Vegas is a housing market living on borrowed time. Every cycle ends the same way in Vegas: hard, fast, and brutal, and the warning signs are aligning again. This is a city where swings aren't gentle, they are violent. And right now, every indicator is pointing straight down. The most alarming pressure is the surge in inventory. Listings have jumped by over 30%, and the number of active sellers is climbing at a pace locals haven't seen since before the financial crisis. Homes that once sold within days are now sitting for 70 to 110 days, and price reductions are flooding the market every single week. Las Vegas thrives on momentum. When that momentum flips negative, the crash accelerates rapidly. Affordability is stretched past the breaking point. The median home price remains around $430,000, but the typical mortgage payment now exceeds $3,000 per month, in a metro where the median household income is only $67,000. That's an affordability gap wide enough to break the market. More than 50% of local buyers are now locked out entirely. A market cannot survive when half of its residents cannot buy into it. The major vulnerability, however, is the employment structure. Las Vegas relies heavily on hospitality, tourism, and entertainment jobs, industries extremely sensitive to economic slowdowns. Layoffs, seasonal instability, and unpredictable income patterns are already pushing thousands of residents out of home ownership. When job confidence collapses, housing demand collapses with it. But the real killer is investor activity. Las Vegas attracted a massive wave of investors, flippers, and out-of-state buyers who bought homes with the expectation of endless appreciation. Now they're stuck with high-interest loans, shrinking equity, and falling rents. Investors don't wait out downturns, they panic sell. And once panic selling begins, the downward spiral becomes unstoppable. Rents are weakening as well, with new multifamily projects flooding the market. When rents fall, investors slash prices. When investors slash prices, homeowners follow. And when homeowners follow, values crumble. Las Vegas doesn't soft land, it snaps. And every supply, affordability, and employment signal is pointing toward the same outcome: a violent correction that hits faster and harder than anyone expects. Number 7. Sacramento, California. Sacramento was one of the biggest winners during the remote work boom. Now it's becoming one of the biggest losers. The market is showing all the early signs of a large-scale unraveling: surging supply, falling demand, affordability destruction, and weakening economic fundamentals, all converging at the same moment. Inventory has exploded more than 45%, pushing Sacramento's housing supply to one of the highest levels in Northern California. Homes that once received 10 offers in 48 hours now sit for 60 to 100 days, and price cuts are rising every week. Sacramento isn't just slowing, it's reversing. The affordability crisis is suffocating the market. With median home prices still hovering near $540,000, the typical mortgage payment has soared past $3,600. That's completely incompatible with Sacramento's median household income of $76,000. When the cost of ownership absorbs more than 50% of take-home pay, buyers stop buying. The market seizes up, and Sacramento's biggest problem is the collapse in out-of-city demand. During the boom, thousands fled the Bay Area and drove Sacramento prices into the sky. That migration pipeline has dried up. Many Bay Area workers are returning to the office, even partially, and the wave of remote workers who pushed the market into overdrive has vanished. Sacramento lost its biggest fuel source overnight. At the same time, new construction hasn't stopped. Builders who ramped up during the frenzy are now stuck with excess inventory. Subdivisions across Elk Grove, Roseville, and Folsom are offering aggressive incentives. Tens of thousands in discounts, paid closing costs, rate buydowns, because they have no choice. Once builders start cutting, the resale market is forced to follow. Another major threat is the job market. Sacramento's economy is heavily dependent on government employment, healthcare, and education. Sectors facing hiring freezes, budget tightening, and slow expansion. When job growth stalls, so does housing demand. The rental market is weakening too, with thousands of new units entering the pipeline. As rents flatten or decline, price support erodes even further. Sacramento is entering a dangerous phase where supply is climbing, demand is shrinking, incomes can't support prices, and external buyers are disappearing. That combination doesn't create a soft landing. It creates a rapid downward reset, the kind that hits middle-class homeowners the hardest. Number 6. Denver, Colorado. Denver has quietly become one of the most overexposed housing markets in America. An over-leveraged, overpriced, oversupplied metro that no longer has the economic engine to support the valuations it reached. What looked like unstoppable growth is now revealing its true form. A market inflated by tech optimism, speculative buying, and a level of demand that was never sustainable. The cracks are visible everywhere. Home prices surged so fast over the last decade that the median property soared beyond $600,000, while mortgage payments exploded to nearly $4,200 on a typical loan. An amount far beyond what Denver's $85,000 median household income can support. That mismatch alone is catastrophic. When buyers cannot afford the median home, the structure collapses upward from the bottom. Inventory has jumped more than 50%, giving Denver one of the sharpest supply increases in the Mountain West. Listings are lingering on the market for 70 to 120 days, a dramatic reversal from the frenzy when homes vanished within hours. Price cuts are happening at a level locals have not seen in over a decade, with some neighborhoods reporting 20 to 30% of listings slashed in a single month. But Denver's most dangerous weakness is the sudden disappearance of its core buyer demographic. The city's tech presence has stalled, venture capital activity has cooled, and remote workers who once flooded Denver have retreated to cheaper regions. The pipeline of high-income transplants, Denver's lifeline during the boom, has weakened drastically. Meanwhile, construction continues. Developers pushed thousands of units into the pipeline during the frenzy, and these homes are now hitting the market at the worst possible moment. Oversupply doesn't just pressure prices, it forces them down. Add Denver's rising insurance costs, soaring property taxes, and a growing outflow of residents toward cheaper parts of Colorado and the Midwest, and the result is a market losing both buyers and stability at the same time. Denver has entered a stage where affordability is gone, demand is thinning, and supply is flooding in. What's coming next won't be a gentle correction. It will be a reset that ripples through the entire Front Range, hitting homeowners who believed Denver was immune to gravity. Number 5. San Jose, California. San Jose is the ultimate warning of what happens when a housing market becomes dependent on a single economic force. For years, Silicon Valley wealth pushed San Jose's home values into the stratosphere, turning average houses into multi-million-dollar assets. But now that engine, the tech sector, is slowing, and San Jose's housing market is standing on a weakening foundation. The magnitude of its vulnerability is staggering. The median home price in San Jose remains around $1.3 million, requiring mortgage payments that exceed $8,200 per month. Even with high incomes, this is an unsustainable burden. A family earning $230,000 barely qualifies. When affordability reaches that level, demand evaporates, not gradually but abruptly. Tech layoffs have hit at exactly the wrong time. Tens of thousands of high-paying jobs across Meta, Google, Apple, and smaller firms have been cut. Many workers still employed aren't buying. They're holding cash, delaying purchases, or leaving California altogether. Net migration out of Silicon Valley has crossed 100,000 residents in recent years, and each departure removes a buyer from the system. Inventory is swelling. More single-family homes are being listed as owners cash out before further declines. Luxury listings, once rare, are now sitting unsold for 90 to 150 days, a time frame unheard of during Silicon Valley's peak years. Even condos, once the entry point, are stagnating as younger tech workers refuse to take on enormous debt for shrinking square footage. Commercial real estate is collapsing too. Empty office buildings, declining tech valuations, and hybrid work are destroying the economic halo that once protected home prices. When the commercial backbone weakens, residential demand follows. The most alarming signal: developers have begun lowering prices on new construction, something San Jose rarely sees. When builders bend, the entire market bends with them. San Jose's vulnerability isn't just high prices, it's the disappearance of the very fuel that kept those prices alive. Without constant tech expansion, non-stop IPO wealth, and aggressive investor demand, the city's housing machine cannot sustain itself. This isn't a soft landing. San Jose is entering a period where the pillars of its housing market, wealth, demand, and investment, are eroding simultaneously. And once that erosion reaches critical mass, the fall is brutal. Number 4. Cape Coral, Florida. Cape Coral is the Florida housing market nobody wants to talk about, because the warning signs are so extreme that they border on unavoidable disaster. It's a perfect storm. Insurance chaos, climate risk, oversupply, and affordability collapse all converging in one place. And unlike other markets, Cape Coral doesn't have buffers. It has exposure. Start with insurance. Premiums in Florida have skyrocketed, but Cape Coral has been hit especially hard. Many homeowners now pay $6,000 to $10,000 per year for insurance, more than some Americans pay for rent. Hundreds of carriers have pulled out, leaving residents with few options. When insurance becomes unaffordable, homes become unsellable. Inventory in Cape Coral has exploded. Listings have surged more than 70%, one of the largest increases in the entire state. Builders went on a construction spree during the boom, flooding the pipeline with thousands of new homes. Now, many of those homes are sitting empty, unfinished, or deeply discounted. Some neighborhoods have price cuts on over 40% of listings at once. Affordability has imploded. Median home prices jumped from the low $250,000 into the mid-$400,000, while the median household income is still barely above $70,000. With mortgage payments surpassing $3,100 and insurance adding hundreds more per month, Cape Coral's affordable paradise image is dead. But the most dangerous factor is climate pressure. Flood risk maps show large portions of Cape Coral facing high exposure, and recent storms have highlighted how vulnerable the region truly is. Insurance companies know it. Buyers know it. Investors definitely know it. And when climate risk becomes part of the price calculation, markets don't correct, they plunge. Cape Coral is also seeing outmigration among locals pushed out by costs, leaving behind oversupply and weakening demand. When a city reaches that point, the only direction left is down. The combination of soaring insurance, massive oversupply, affordability collapse, and environmental risk makes Cape Coral one of the most fragile housing markets in the United States. And once downward momentum begins, it won't stop easily. Number 3. Austin, Texas. Austin is the closest thing America has to a housing market on life support. This is the city that went from the hottest market in the country to one of the biggest reversals in modern housing history. Prices climbed so fast, so irrationally, that the correction we're seeing now isn't temporary, it's structural. Start with the implosion of demand. Austin's median home price shot above $550,000, while local incomes never followed. A household earning the city's median of $86,000 is now expected to survive a mortgage payment pushing $4,200 per month. That mismatch doesn't just strain buyers, it removes them entirely from the market. More than 60% of Austin households are now priced out of the median home. Inventory has gone from scarce to unmanageable. Listings have surged over 140% in some parts of the metro. Entire neighborhoods that sold out during the frenzy are now stuck with rows of unsold homes sitting for 90 to 150 days. Sellers are slashing prices, offering tens of thousands in incentives, and competing with builders who are desperate to offload inventory. Construction is Austin's biggest time bomb. Developers built aggressively, expecting demand to stay permanently overheated. Now, thousands of new homes, spec projects, and luxury units are hitting the market exactly when buyers are disappearing. Oversupply doesn't just soften prices, it pulls the floor out from under them. The tech slowdown has also dealt a fatal blow. High-income workers who once fueled Austin's boom are now cautious, laid off, or relocating. Meta cut workers. Amazon cut workers. Google froze hiring. This is not the environment where $600,000 suburban homes continue appreciating. Austin's rental market is weakening too. With thousands of new apartments arriving, rents are dropping, concessions are exploding, and investors are panicking. When rents fall, the math for investment properties collapses, and landlords respond the only way they can: by liquidating. Austin isn't in a cooling phase. It's trapped in a downward spiral created by unrealistic pricing, massive oversupply, and weakening economic demand. The illusion of endless growth has shattered, leaving behind a market that rose too fast, stretched too far, and now must fall hard enough to reset itself. Austin's correction won't be mild. It will be one of the deepest in the nation because the boom it's correcting from was one of the most extreme. Number 2, San Francisco, California. San Francisco is the most dramatic housing reversal in modern America. A collapse disguised behind numbers that still look expensive, but hide a market losing strength at every structural level. This is a city where the price tag no longer reflects demand, and the cracks are widening faster than anyone predicted. Home prices may remain above $1.3 million, but the real story is the vacuum underneath. Mortgage payments easily cross $9,000 per month, pushing even six-figure earners out of the market. When a city requires a $300,000 income just to afford a typical home, the collapse begins not with panic, but with silence. Fewer buyers, fewer offers, fewer reasons to stay. The exodus is staggering. More than 140,000 residents have left the Bay Area in recent years, draining billions in purchasing power. Tech firms aren't expanding the way they once did. IPO wealth has slowed. Stock-based compensation, the engine that once funded down payments, has weakened. When the economic foundation cracks, the housing market collapses with it. Office vacancies have exploded beyond 30%, creating a commercial real estate disaster that bleeds into residential demand. Empty towers, bankrupt landlords, and declining downtown activity translate directly into shrinking buyer confidence. Entire neighborhoods are seeing listings linger 120 to 180 days, something unthinkable during the tech boom. Price cuts are now standard. Luxury homes once selling instantly now sit waiting for buyers who no longer exist. Investors are fleeing, international buyers aren't returning, local buyers are hesitant and fearful. Add the escalating insurance and maintenance costs that accompany an aging housing stock, and San Francisco becomes a market too expensive to enter and too unstable to sustain itself. San Francisco isn't just declining, it is unraveling. A market built on endless tech wealth cannot survive when that wealth slows, when residents flee, and when commercial districts collapse around it. This isn't a gentle correction. San Francisco is experiencing a multi-tiered breakdown: economic, demographic, commercial, and structural, all converging into one of the most significant housing reversals the city has ever seen. Number 1. New Orleans, Louisiana. New Orleans is the most fragile housing market in the United States, a market pushed to the brink by forces that no city can outrun: climate exposure, insurance collapse, population decline, and economic instability. What's happening in New Orleans is not a downturn. It's a full-blown systemic failure. Start with the insurance crisis. Premiums in New Orleans have surged to catastrophic levels. Many homeowners now pay $7,000 to $12,000 per year, and some exceed $15,000. 16 insurance companies have pulled out of Louisiana in recent years, leaving homeowners trapped with unaffordable coverage or policies that barely protect them. When insurance becomes a luxury, homeownership dies. Population decline is accelerating. The city has lost more than 50,000 residents in recent years. A shrinking population means shrinking demand, shrinking tax revenue, and shrinking stability. Every resident who leaves pulls another thread from the housing market safety net. Home prices don't fall gradually in markets like this. They collapse. Inventory continues rising, listings sit for 120-plus days, and price cuts spread across every neighborhood. Investors refuse to enter. Young buyers refuse to return. Even longtime residents are giving up and leaving. Climate pressure is the final blow. Massive portions of New Orleans sit in high-risk flood zones. Insurance companies know it. Buyers know it. Lenders know it. Every storm season increases volatility. Every updated FEMA map tightens the noose, and the economy isn't strong enough to fight back. Tourism is volatile. Local wages remain stagnant. The job base is too narrow to support a healthy housing market when costs explode. New Orleans is not facing a correction. It is facing a structural unraveling, a city losing people, losing affordability, losing insurance, losing economic support, and losing time. This is the most exposed housing market in America, and the one with the least ability to survive the pressure.